Hey, everybody, we're going to talk about some of my favorite opportunities in the stock market. Before we do, please click subscribe to my channel and take a minute to check out a message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. So, fintech means a lot of different things to a lot of different people. And Tyler and I both have a fintech in mind right now that we love as long term investments. And they're both very different. So, I'll go first because I have the more traditional fintech, I guess I would say, in what people think of as a fintech company. I really am a big fan of SoFi as a long term investment. The company is a bank, but it just became a bank at the start of 2022 when it acquired a three branch Southern California bank that didn't really add much to its business other than a banking charter, but that's very significant, and you'll see why in a second. Growth has been absolutely phenomenal, but there's a big asterisk that I'll get to. So SoFi now has over 5.2 million members. That's up 51% year over year. Those members have 7.9 million products with the company, a product being like a checking account, a personal loan, things like that. So the average member has more than one product. The financial services side of the business has grown really fast, up 60% year over year. That includes primarily bank accounts, brokerage accounts, and credit cards. And the reason that that's significant, that it's growing faster than the lending side of the business, is that it creates a natural marketing funnel. The big asterisk that I mentioned is that SoFi's acquisition cost is very high. It didn't get those members for free. It offers the best in class bonuses when you open a checking account, when you refer a friend for a loan, when you refer a friend to a brokerage account. It offers great bonuses, and that makes its acquisition cost really, really high. And the kind of goal is that it's going to use that to build up people who use SoFi as their bank. And that will create a natural marketing funnel for the lending side of the business, which is very profitable. So revenue grew 58% year over year in the fourth quarter. SoFi is expecting another 25 to 30% revenue growth this year, which is pretty impressive given the environment. And it expects to be profitable on a GAAP basis by the fourth quarter of this year. There are a few catalysts to make that happen. The student loan restart is a big one, assuming it actually happens. I don't know about you, Tyler. I have student loans. I haven't made a payment on them in 3 years. So the student loan restart is happening supposedly by the summer. And SoFi's core business, the one it started with, was student loan refinancing and private student loans. No one's had a need to refinance a student loan in 3 years. So that side of the business has been dead, which makes its growth even more impressive. The deposit base is growing fast, and that's very significant. The cheapest way for banks to fund their business is with deposits, not by borrowing money. SoFi started from zero at the beginning of 2022 when it got its banking charter, and now has over $7 billion of consumer deposits, covering more than half of its loan portfolio. Once that approaches 100% or even gets slightly above it, it will dramatically lower the bank's cost of capital. And I see that happening by the end of 2023. The company is not yet profitable. I mentioned the high acquisition costs, and there is a lot of execution risk. No fintech has been able to be a wide-scale bank replacement yet. We've seen a lot of companies offer things like high-yield savings accounts and become kind of banking-adjacent products, where people will still have their account with Bank of America, but then will get a high-yield savings account on the side. SoFi aims to be a complete bank replacement. And if it can successfully do that, it will be a massive win for investors, but that is a big if right now. Tyler?
Yeah, so I don't know if a lot of people would consider this a fintech company, but if you really dig down into the guts of S&P Global, you will find a very tech savvy financial data company. If you're maybe not 100% familiar, I'm sure you've heard of S&P 500. Well, that's what they do. They build indices, they build indexes, and they build benchmarks. It's one of the many things that S&P Global does. And obviously, so say I'm a hedge fund, say I'm another financial institution, and I have products or certain my investment strategy, and I want to bring in people. If I want to benchmark my fund or whatever to a S&P, benchmark indice, I have to do that. I have to pay them to do that comparison. If I'm a passive ETF, like somebody like Vanguard or BlackRock or State Street or something like that, and I want to build a passive ETF based on their indice, I have to pay S&P Global to do that. That is one of the core drivers of their business. And this is just one of the many. They own Dow Jones. So if you want to index to the Dow Jones indices and any of those, same thing. And they also have some consumer facing ones that we might not never typically think of. If you have ever had a Carfax report, then you're an S&P Global customer. And then beyond that, you start to get into some of even the wonkier ones. I don't know if any of you are commodity traders out there and happen to look at a thing called Platts. Well, that's an S&P product too. One of the things that I love about financial data companies, they basically look around and go, who are you going to go to? Who else? Right? There's not, whenever it comes to things like this, it's an extremely wide moat business because it's such a sticky thing. There's like this investor psyche around the idea of benchmarking to things like the S&P 500. You don't hear as much about the Russell Total Index or the Russell 2000. Russell 2000 is kind of known, but not nearly as much. I mean, the S&P 500 is on the 6 o'clock news in the evening. And things like that make it so sticky, so ingrained in our idea of what investing is. It's just it's a hard, sticky thing to break. And S&P has made it immensely profitable. If you look at every single division they have, their operating margins are well above 40%, and they're an immensely profitable business. Now, what makes them interesting, I think, in terms of a growth perspective from here on out, is they have a very much a global strategy. A large portion of their revenue is North America and Europe. And let's face it, Asian markets are growing. African markets are growing. Latin American markets are growing. And they're going to need somebody making these data decisions, making these indices, making these sort of products that people who want to invest in those countries can benchmark to, or things like that. And it's just a business that throws off a lot of cash and does a lot to reward investors. The yield isn't super high because it's a pretty well it's a good business, and so it doesn't go on sale a lot. But over the past 10 years, dividends gone up 15% annually. They've done more than 20 billion in share purchases over the past 10 years. It's just a company that has shown over the long term to reward shareholders for sticking around because it's such a good business.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.